Hi, everyone. Thanks very much, David. I should start by saying, David, the way you're going with your unbelievable pronunciation of vergelegen, in about 100 years you'll get there. But do keep trying. Secondly, we've changed the agenda because your hands are now so ginger that this session is going to be a writing session. So I hope you all get hold of your pens and are ready to write. I'm joking. But the good news is Duncan and Al kindly arranged for the wind to stop overnight. So hopefully we'll have a more easy time chatting to each other today. Anyway, it's a great privilege for me to be talking to you. I've been asked to talk a little bit on the past. You know me as you do, so the chances are I might just say something on the present and the future, but obviously there's much more of that to come in the course of the day. What I thought I would do, particularly given the state of the market, the state of the world we're in, is just think a little bit about the past. Now, many of you have been in the diamond industry far longer than me, and so I do this with some trepidation because you and your families have been in this business for many, many years. I'm a relative newcomer at just under 20 years. But even in those 20 years, there have been a number of themes that we've lived through. And these are slightly different to the ones I spoke about tonight, which I think it's worth bearing in mind as we think about the future. Because whilst the future is never the same as the past, there are tremendous lessons that we can take from the past. And there's tremendous things and positivity that I think we can all think about arising out of many of the difficult moments of the past. So I thought I'd take you through some of those in the first instance. I can't, of course, do this without starting a little bit with the present. I don't need to tell any of you how difficult the situation in the diamond industry is today and how difficult the situation in the world is today. That's a simple graph of where we see polished price having fallen in the course of this year, and the bottom of that graph, our rough price index. And the polished price index, of course, is one that we take from all of the publicly available indices, and we triangulate that with our own data, and the rough index is our index. Now, you'll see from that what I don't need to tell any of you, that it's been a very difficult year. And both rough and polished prices have fallen. The gap between rough and polished, it's important that over the cycle it stays in kilter. Sometimes it falls out a little bit, but you can see from that something that I don't need to tell any of you. I think the first thing to think about is why we are in this situation. What has caused it, and are there any lessons from that? Now, again, I don't need to tell any of you, but every time there's a crisis in the diamond industry, it's unlikely that it's caused by just one thing. This is a complex business, it's a complex world, and it's very, as I like to call it, multifactorial, the reasons we are in the situation we're in. So I'm going to put up 5 or 6 different reasons I think we're in the situation we're in. Please send your feedback in on the app as to whether you disagree or have other thoughts on it. I don't think any of these is particularly determinative, and in fact I think it's the cocktail of all of these that have come together in the course of 2023 that has made it such a difficult year. The first one is Chinese diamond jewelry demand. Now, we all know that China has been a big growth engine for the world and a big growth engine for the diamond industry, and as you know, it's probably less price competitive than America, so it's an important market for all of us to be growing. We all benefited from tremendous Chinese growth over the past decade. But this slide illustrates to you how Chinese diamond jewelry demand has been less good than we would have liked it to be, and I dare say we would have expected it to be coming out of COVID. So that graph is just total diamond jewelry sales in China, in US dollars, in nominal terms. And from the highs of 2019, we haven't got back to that number. And this graph is nominal, so if we did it in real terms, the differential would be even bigger. The drop, of course, in 2020 doesn't need explaining. That was COVID, retail stores were closed, we all went through a terribly difficult time. And then there was a decent recovery, actually, as the world came out of COVID. But the Chinese consumer has just not come back to Chinese diamond jewelry the way the American consumer did. And there are a lot of reasons for that, and I think most of them don't relate to the diamond jewelry world. Chinese consumers are naturally more cautious than Americans. They are stronger savers than America. In times of crisis, they will buy, as we'll show you later, gold more than diamond jewelry. Fundamentally, I think they came out of COVID not having been given free money, as American consumers were in COVID. I think fearful of another lockdown and much poorer than when they went into COVID. And you contrast that to America, where consumers were given money by government during COVID, largely free money, actually, and as the world came out of COVID, they spent it like crazy. I don't think this means that the Chinese consumer is lost to us at all. China is having terrible economic problems. Those of you who follow the Chinese property markets will know how bad it is. China has tools, of course, to overcome these kind of issues. And so I'm sure we will get back to better demand. But I think that's a principal reason. The second one that I don't really need to spend too much time on, David's spoken about it this morning and I touched on it yesterday. But it's fair to say that geopolitical instability is terrible for consumers. It's terrible, of course, for all of us. And it's most terrible for the people involved directly. But of course, coming out of the Russia-Ukraine war was unprecedented inflation in the developed world anyway, and I'll touch on that in a minute. And this, the other thing I think to say about that war is we all thought it would be over in 3 weeks. Well, we're 18 months into that war, and it feels a little bit like a stalemate. So that's a problem, obviously much more for the people involved, but it's a problem for all of us, I think, as it works its way through supply chains and so on. And then, of course, David has spoken, I spoke last night about these terrible events in Israel. They, of course, can't help anybody in terms of consumer confidence. And as I say, I don't for a minute trivialize the human hurt involved in that. So one of the things that definitely is a result of coming out of COVID and then the Russian war is this very high inflation in key markets. And I know you'll have done what we did, which is look at all those economic forecasts, and it'll all be over by the end of 2022, and that inflation will come down in 2023, and of course it doesn't do this as fast as we would like. But that's a startling slide. That's consumer inflation in 3 key countries, Japan, the US, and India. So if you look at the US, inflation has gone from about 2% early in 2021 to as high as 8 or 9%. For those of you who've only lived in the developed world, that is an enormous increase to have to handle. That's a 400% increase in your mortgage cost and your credit card debt cost. And lots of people in America have lots of credit card debt. So it's hardly surprising that inflation pushes down consumers' buying power. And the other thing, of course, we know is that stock exchanges are depressed. People's pensions don't look as good as they used to. They are inclined to spend less. That will pass. There's some signs in America that it is coming down, and I think that will be a hopeful sign as we go forward. The same in Japan, I mean, even worse in a sense, and they've had negative interest rates for as long as I can remember, so for them to get to 4% is a huge, huge increase. India, obviously a country maybe more used to living with higher inflation, and has, in a sense, handled the war rather well from an internal Indian point of view, but is also looking at inflation. That really saps consumer confidence. As I said last night, and I can't pretend to stand here and say lab-grown is not an issue today for the natural diamond industry, that has been another factor in what has depressed consumer demand for natural diamonds in 2022 and 2023. You can see on the left-hand side of that graph the rapid increase in production of lab-grown diamonds all around the world. The 23 number is obviously a projection of ours. But I firmly believe, and I know Paul will unpack this in a bit more detail later on, that partly as a consequence of that, and partly as a consequence of all the other work that we're doing and people like us are doing, the gap between lab-grown synthetics and natural is rapidly expanding. That graph on the right-hand side is an extraordinary graph. Those are 3 price points for lab-grown at wholesale, polished, good quality, so GVS stones. They've gone from, if you look at a 3-carater, that red line, nearly $2,000 a carat to about $200 a carat over this really short space of time. And the other thing that's interesting in that graph is that all of those are now worth roughly the same price. A 1-carat, a 2-carat, and a 3-carat have all collapsed at wholesale to that very, very low number. Think about what a natural 3-carat GVS is worth. In the polished, call it $25,000. It's miles away from that number. And I think we are now getting to the point where these 2 markets are separating faster. It's not happening as fast as retail, but Paul will take you through again. It is starting to happen, and I do think we've got to do more as the natural industry to do more to differentiate our products. But I think that is a phenomenally interesting slide, and I don't see why that trend won't continue. As production gets more, and costs come down. As we've always said at De Beers, this is a technology play. It's not really a luxury play. Another thing I think we like to forget in the diamond industry is this. We live in an era of, I wouldn't quite say boom or bust, but we live in an era of difficult cycles and then rapid recoveries. Almost all the rapid recoveries I can remember have almost recovered too fast. And that's great when we're in the moment. So, 2021 and 2022 were fabulous years to be in. But if you draw that line of what our trend line for essentially global diamond jewelry demand in nominal US dollar terms from 2016 to 2026 over a 10-year period, let's say growing at about 2% real, which is roughly the numbers we've thought about in the past, you can see that the collapse with COVID and then the bounce back post-COVID are not linear. So if you look at that shaded in bit, we all benefited from that, but it doesn't follow that that can just continue off that trajectory. We have to get back to the mean at some point. And if you go back and look at all our data on all recessions, there's been a rapid bounce back, a slowing down, and then a reversion to the mean. So even though that was a fabulous, fabulous year for all of us, sometimes I think we forget that that's probably not sustainable off that level. And so partly I think what we're suffering from now is an overbuying in 2022. And if you think about American consumers, when they came back from COVID, luxury travel wasn't yet back in the game. People weren't traveling as much. They were still a bit nervous of COVID. And so we had a nice cocktail of things working in our favor in 2021 and 2022, which has probably worked its way out. But I do think we will revert to the mean, and then it's again up to us to see how we can grow demand by more than that. Another thing I'd like to touch on is this concept of we're not alone. We're very good in the diamond industry at thinking it's only our industry that is suffering. And of course we're suffering. But I'm sure if you grab Duncan over lunch, he will tell you stories about all kinds of other parts of the world that are really suffering in much bigger businesses than De Beers and the diamond industry, because it's a global phenomenon, this, caused by the issues I've touched on. So all luxury players are struggling. They've had great years and great times. Doesn't really matter who you look at here, Hermes, Richemont, LVMH, Kering, all of them have really struggled in the last 6 months or so for the same reasons that I'm talking about that we've struggled. And those are not their diamond businesses. Those are their big luxury businesses. I mean, you all know the size of LVMH. All of the luxury world is experiencing a slowdown in consumer spending. But it's not just the luxury world. I've put up a couple of the big mining companies here, BHP Billiton, Rio, and Vale, which is a big South American business largely in iron ore and copper. They are all suffering from the same thing. It depends where you start these graphs, it depends on the scale you draw them, but everybody is suffering from less demand. China isn't building cities at the scale it used to, and people aren't rolling out electric cars as fast as we would like, and so on and so forth. So the world, we should just remember, I think, is in a difficult space. We are not unique. Everyone is going through difficult times. So now I thought I'd go back and just look a little bit at the past. So this graph has got on it the 5 challenging times, you can call them recessions, you can call them downturns, cycles since the start of the millennium. And there's one thing to look at on that slide. One is these things do happen. The world is a cyclical place. We do have ups and downs. Things happen in the world that cause consumer spending to be depressed, that cause interest rates to go up and so on. So that's the first point. You could conclude from that they happen sooner now than they used to. They're closer together. I'm not sure there's enough data to conclude that, because the current crisis was triggered by such an externality that we couldn't predict, which was the war, I think, in Ukraine. But I think we need to be more nimble in our businesses in the future in case these things happen more regularly. But what you will see from that slide is every single one of those downturns was followed by an upturn. As night follows day, these recessions and downturns end. People do feel more confident, and they do come back and start buying. So as long as we continue to do the good stuff we do, work together better, continue to invest in marketing and all the amazing stuff you folks do, this crisis will end and the world will recover and we'll have a great opportunity. Now, as I said earlier, not every crisis is caused by the same thing. And I know you will say to me, yes, Bruce, this crisis is different to the last crisis, and there's more of this in lab-grown in this one than in the last one, and you're right. But no crisis is the same. So the crisis after 9/11 was really a crisis of demand. The world was in a terrible situation. Nobody was buying straight after 9/11. The global financial crisis was 2 things. It was demand, and it was a financial crisis. And I'll come and touch on that in a minute. The Chinese slowdown in 2014 to 16 was a demand crisis. COVID, the worst crisis I ever lived through, and I'm sure the worst one you ever lived through, was everything. It was demand, it was supply that was affected, financial issues were affected, and of course, it was a health crisis. This crisis is undeniably a demand crisis, and you can see, of course, that's common to all these crises. So, I take away from that, we should not be afraid of a crisis, we should be prepared for it, we should do the work we should do to make sure we recover well from it, And one day there will be another one, but there will always be light at the end of the tunnel. I'll unpack these in a little bit more detail. 2008 and 9, diamond jewelry demand fell by 18%. Now, those of you with long memories will remember how scary this was. In September 2008, you'll remember Bear Stearns failed first. And then the US Fed allowed Lehman Brothers to fail, and that became close to a global financial catastrophe. I remember a great story when the UK government was thinking about bailing out NatWest, the biggest high street lender of them all, and actually still state-owned. And the governor of the Bank of England phoned the Chancellor, Alistair Darling, and he said, if you don't guarantee the deposits of all our deposits, this bank will fail. And Alistair Darling said to him, how long have I got to make this decision? Because no government wants to make the decision. Thinking a few weeks, he could go and talk to cabinet, he could go and test the markets. And Mervyn King said to him, 2 hours. That's how fast the world changes. And that's how fast this crisis was upon us. So that was terrible for us. I won't never forget the sights of August, September, and October, I think it was, Paul, of 2008. I do add one other thing here, is our balance sheet at De Beers in this crisis was in an awful position. I made a vow I would never let it get back into that position. And as we go into the current crisis, as the speakers later will talk to you about, we're in much better shape to deal with this crisis. We had to take some really, really radical action in 2008 that we wouldn't have to do again. And so that did contribute to it, but you can see the massive drop in our sales between 2008 and 2009, and that's a common theme. Every time there's a crisis, De Beers steps in and helps. It's very difficult for De Beers, it's very difficult for Elle, because nobody else does this, but De Beers, as the leader of the industry, always steps in to help, and you'll see that trend throughout these slides. But what you can also see is when the crisis bottomed, there was a rapid recovery, and you can see how our sales recovered and then exceeded previous sales in under 2 years. So there, out of one of the worst crises we could remember, was a rapid bounce back because of the responsible way I think we all behaved in the crisis. The Chinese slowdown was more a slowdown of demand. I don't think there was a financial issue in it, and also overstocking in the prior periods, and that's a common theme of these slowdowns, is people overstock in good times, and then bad times arrive, and then it's very difficult because you've got to protect your inventory, you don't want to buy anymore, and you kind of got to clear that out of the system. So that was a difficult crisis. There was a reasonable slowdown in demand. It had a very disproportionate effect on our sales, because once again we did the right thing, but once again there was a big bounce back. COVID I've chatted about. It's extraordinary in its own way because all the retail stores in the world got shut. But there you can see again, we had a mammoth drop in diamond jewelry demand. 13% is a huge number. And we as De Beers, for the first time, I think in our history, stopped having sites. But we did amazing stuff with you. We did virtual sites after that. We did sites all over the world. We had fantastic cooperation from the Botswanan government about doing sites not in Botswana because no one could get into Botswana. And there's another lesson there. When there's a really, really difficult crisis and no one can see how you solve it, we find a way together. You folks trusted us. We sold you goods virtually unseen. I don't think that happened with anybody else. And that's because of this long-term relationship we've all built together. We should be using that more in these crises to come together more and get through them. And again, you can see a mammoth drop in our sales and a great recovery as the world recovered after that. And where do we find ourselves today? So I'll talk less on today and the future than others. I can only say to you this. One is, we have already taken pain in the course of this year, and I'm sure Al, as I said last night, doesn't particularly thank me for hiring him just before a terrible crisis, but unfortunately we didn't know it was coming. And he and the team have done exactly what you would expect De Beers to do. Do this responsibly, talk to you, travel around the world and get together with you and talk to you and kind of work out a way of getting through some of these very, very difficult times. And I know we'll get through it and come out of this stronger. I can't say any better than you when that uptick will come. I'm hoping, like all of you, it will come sooner rather than later, but I do know it will come. So let me close on a couple more thoughts. One is why we remain so confident. I touched on this last night, but I remain as confident in the future of the natural diamond industry today as I was when I started at De Beers in 2005. And there are a whole lot of reasons for it, and I sometimes think we forget these reasons, and it's worth reminding ourselves about them. Firstly, supply. And we've been telling you for years that supply has peaked. And there were years and years and people didn't believe us. Oh, there's more supply here and there's more supply there. This is our latest view of supply of diamonds over the next, let's say, 15 years. at flat prices. Now, if we don't grow prices by more than flat, then we've all got another problem anyway. But if I showed you that at real prices or at flat real plus whatever, you would see an even bigger gap. What that shows, and of course production doesn't go nicely in a line because mines don't work like that, but what that shows is over time, and that's putting in all the mines we know, all the projects that we think will be built, and there are very few of them, and even some that probably won't be built. There is no analysis that tells us there's a tsunami of new supply coming here to disrupt the supply-demand model. That's a good place for an industry to be in. I wouldn't wish this on anyone, but you saw last night Stornoway going in for the second time filing for bankruptcy protection. And you saw the Quebec government saying they would not bail them out this time. I don't know where that ends, and as I say, I wouldn't wish that on anybody, but I think you can expect that to be probably an overly optimistic graph of supply over the next 15 to 20 years, which is good for us as long as we keep doing our jobs properly. Here's the best slide, though. The consumer's love affair with diamonds still, natural diamonds I'm talking about, still ranks the natural diamonds amongst the top desired luxury gifts among women in all of our 4 top markets. That is not a piece of research we did 10 years ago. We've shown you this before. That's a piece of research we did this year. And you will see that in the key markets of America, China, and India, natural diamonds are the first, second, or third thing any consumer would want to buy if they have excess funds. Not lab-grown, natural. That is a great place to be. So if we're in a world where the consumer still loves our product, and as I said last night, notwithstanding the competitive set has got bigger, I think consumers today love diamonds as much as their parents and their parents before them. They love them in different ways and they demand different things out of all of us, but they still do. If you can attach that to the supply outlook, we're in a position very few industries are. So, what do economists tell us about the future economically? Now, this comes from Oxford Economics. As a rule, De Beers uses Oxford Economics because I think it's important to use one set of data and not pick and choose the data that suits you. Largely, I should say, in my time at De Beers, Oxford Economics has been accurate, but you could go and look at anybody else's economic forecasts, and I'm sure some of you will think some of these forecasts are quite bullish, but what they think is, in general, on the left, world GDP will grow at faster than we would think over the coming years. That's across the whole world. Inflation will drop. Now, I did say earlier, inflation always drops slower than people predict, but they are still predicting global inflation, I'm not talking country by country, to fall to within reasonable limits by 2024 at the latest, and that would be very good, particularly if it falls fast. That makes consumers' confidence, their pension values go up and so on. Really important slide for all of us, though, that is what does that mean for disposable income in the key markets, because that's a key for people to have money to spend. Then we've got to go and get them to spend on us. So on the left-hand side there, you see US personal disposable income, Oxford Economic actuals in terms of the solid blue line, and you can see the difficult collapse at the end of 22 and where we are now, but there's a significant prediction of very significant uptick in disposable incomes in 2 key markets as the world recovers. And that's, as I said earlier, because the world is in a really awkward spot. But history shows us we get through them and the bounce back is good. And in India, which is a market I know all of us think we can do more in, and has actually been probably the market that's performed the best in the last 12 to 18 months, those predictions are even more positive on the right. So if you add all of these things up, I'll come to this in a minute, but if you add all of these things up, you must say we're in a really good position. We have a product that people still love. There are lots of competitors out there. We have declining supply, and we have a possibility of real GDP growth and real personal income, disposable income growth. I'm not making light of this, and let me be absolutely clear on that. I'm going to leave it to Paul to talk more on it, but if you just look at the slide on the right, I have no idea where those prices will go. That is not a prediction. It's just showing you there is possibilities that those prices will go even lower. They're not going to go any higher, and it has to follow that retail prices will start to come down. And lab-grown will be what we always said, a perfectly acceptable fashion offering. I agree with a number of you who I've spoken to today and last night. We need to do more in this space. So I'm going to leave you with just 2 thoughts, because it's not for me to talk about the future. Al and others will do that. But 2 things I think we could think of doing better, if I think about my time here. The first is working together better. In general, I think we've worked together really well over the last 7 years. And I think you will agree, these kind of functions, and I'm thrilled that Paul and the team decided not to cancel it, because it is important we get together and talk and spend some time together and have some fun together, actually. But I think the world is so difficult, we have to cooperate more. These G7 sanctions, the next round that are coming on Russian goods, is a great example. Oftentimes, when it's difficult in the diamond industry, different parts of the industry like to find a solution that works for them. And I understand that because you're always looking after your own business, as you should be. My own view is we should be working together more to design a solution that works for everyone. So I totally support the open letter Al wrote the other day, which reflects all of De Beers' views, which is we have to solve this problem as an industry working together. We have to talk to producer governments. We can't leave them out of this. We have to talk to all our customers. We have to talk to all diamond centers. And it will be difficult because getting consensus in this industry is not easy. It's one of the never-ending list of tasks that Ferriol has to quickly sort out by next Thursday. But I think, in all seriousness, if we can do this and come together and solve a really complicated and difficult problem together, we'll show each other and the world what we can do. And then there are two other things we have to do better, frankly. Or one other thing, I'll leave the second one for later. We have to tell our story better. We are all involved in businesses that do amazing good. We all struggle to tell good news stories because bad news gets out much quicker than good news. We have got, every one of you when I go and visit your factories or when I talk to you, do amazing things. And we do incredible things as De Beers, things that we're really proud of. These are the things that will help us differentiate natural diamonds from anything else. And we have got to be better at telling the story of what the good we do collectively is and that a manufactured product just can't do. We have the tools. We have the content. We've got to work better together to do that. I know we can, and I know we will. So those are basically just two thoughts I thought I'd leave you with. I don't, as I say, going to talk about the present and the future. People who are much closer to that will do that. But I'd like you to take away from this session my thoughts that we are in a difficult time. We've been through many difficult times. We will go through more. But we still have a product and we still have a set of macroeconomic circumstances that allows me to think we can be the winners as we have been in the past. Thank you so much. I look forward to seeing this journey with all of you in the future. Thank you.